In this week's video, we'll review the latest charts and data to help us understand why inflation may be hard to tame, and that's bad news for balanced portfolios. We'll dig a little bit deeper into the concept of sticky inflation, the potential impact on asset allocation, some key takeaways from a difficult year in 2022, a notable demographic difference in this cycle, and how all of this ties into the secular bull market thesis, and we'll see what we can learn from recent market signals. Since it's possible we're operating under significantly different circumstances, we'll recap some important topics relative to inflation and then expand on them, with the objective being the more we understand the environment, the easier it's going to be in terms of execution in the coming years. So let's start with the potential longer-term opportunities related to the secular trend that we covered several weeks ago. You saw a lot of improvement near the debt ceiling from, let's say, mid-May to early to mid-June. And in the remainder of June, the market responded to those positive setups. So from a longer-term perspective and a shorter-term perspective, we still have favorable setups. And as long as that's the case, we want to be ready to take advantage of them. Another recent video discussed asset allocation and the distinct possibility that things could be significantly different if interest rates have flipped from a long-term downtrend starting in roughly 1982 and ending near the COVID low to a long-term uptrend. It's important for us to understand the fundamental drivers. Most of us are used to investing in periods of low inflation and a bias towards lower interest rates, and thus, anytime we hear anything about higher interest rates, we naturally become skeptical relative to any bullish probability. Well, as we've noted, interest rates rose significantly down here in 1950 into the mid-1970s, and that was not a showstopper for the stock market. This is 1950 here into the 1970s here. And as covered in detail recently, 2023 shares a lot with this period here, 1956, and this period here, let's say early 1989. And in both cases, there was significant long-term upside in the stock market. It's very, very difficult to overstate the importance of interest rates. Interest rates are embedded into almost every important market and economic equation. So let's recap fundamental drivers impacting inflation and interest rates, and then let's expand on those concepts, because fundamental understanding can help with execution. If we were to review this chart objectively going back to 1981, 1982 up here, it's probably fair to say this period in here looks different relative to this period in here. And last year's extremely weak performance in bond ETFs and gold, and full-year returns on our screen here ranging from negative 25% here all the way to negative 67% here. The fact that numerous playbooks that were extremely helpful in this window here weren't particularly helpful last year, and that includes the CCM market model, and the fact that you can make a rational argument that 2022 was the worst year ever for balanced portfolios made up of stocks and bonds, it's difficult to make the argument that performance in 2022 doesn't align with this concept here and this concept here. And the countless never-seen-before events that happened in 2022 seem to align with the theory that it's possible that the era of ultra-low bond yields, mild inflation, and accommodative Fed policy, all of that possibly in the rearview mirror, or at a minimum, more muted than what investors were accustomed to in this window here. A secular shift like this can be intimidating, and abnormal drawdowns, abnormal returns during a bear market, and disappointing performance can weigh on the confidence of human beings. In the world of sports, after a tough loss, you often hear, "Let's not let one loss turn into another." And that speaks to remaining confident and composed after difficult periods. So quickly, how did we get here? When interest rates were in a secular downtrend, central banks were very concerned about the economy and asset prices experiencing a deflationary spiral. In the old world, there were a lot of factors helping the Fed keep inflation under control and arguably making deflation their primary concern, which led to quantitative easing, negative interest rates, and provided a setup that was ripe for what turned out to be significant overstimulation and policy shifts and a misread on their effects when inflation started to rise. And when inflation really started to take off, central banks realized they were fighting the last war. Massive stimulation in an environment where many of the drivers that were helping drive down inflation had flipped to drivers that were pushing up inflation ended up having some pretty significant consequences for the U.S. markets, the American economy, and for that matter, the global economy. So eventually, the Fed pivots. But most likely, due to concerns about financial instability, they went exceedingly slow and continued quantitative easing into the first quarter of 2022. And then they slammed on the brakes hard. Now let's expand on this topic here and see what we can learn. When any market moves from point A down here to point B up here, there are numerous factors involved, including psychological factors and fundamental factors. We never want to underestimate the role of human psychology. Bloomberg Business Week cover, April 2019. Economist cover, October 2019. And with all of this driving policy and inflation remaining tame for a long period of time, even in the face of very aggressive policies, we can understand how humans begin to think this way and this way. And the belief begins to grow that the government can solve any problem by sending out checks, because we can always print more money to pay interest on the debt. And when the fundamental drivers shifted, the law of unintended consequences kicked in. We had gone from easy money to ultra easy money to highly questionable easy money. And as you might imagine, a lot of easy money creates a lot of debt. And it's helpful if we understand the basics of the role of debt walking forward and why inflation may be very difficult to tame, especially if the Fed tries to go it alone. CNBC article on the left side of your screen dated August 29th, 2022. It's about a white paper that was released at the Fed's Jackson Hole Summit. One of the key findings in that white paper: the recent fiscal interventions in response to the COVID pandemic have altered the private sector's beliefs about the fiscal framework. This speaks to a fundamental and psychological shift. The paper goes on to say that the present-day inflation that we have has largely been driven by deficit spending. The paper also stated that it's possible that the Fed's not going to be able to do the job by themselves, and if the Fed continues to raise interest rates, it could actually make matters worse. If market and economic participants have lost faith in the government's ability to manage our debt prudently, something that is absolutely evident in price action of TLT, the long-term Treasury bond ETF, and its performance last year and this year to date. Do I really want to hold U.S. debt with maturities that far out when it's possible we've witnessed a secular shift in interest rates driven by enormous amounts of deficit spending? How is it possible that interest rate hikes from the Fed could actually make matters worse? Straight from the CNBC article, and the article is based on the white paper from August of 2022. To help us answer that question, let's review a great analogy from Lynn Alden, Twitter handle here. Makes a reference to Alice in Wonderland. When Alice went through the mirror in the famous book Through the Looking Glass, everything was flipped and different. Repeating, everything was flipped and different, which is where this comes in, and this comes in. So let's walk through the analogy. Sovereign debt, government debt. When sovereign debt is low, and most money creation comes from bank lending, higher interest rates do exactly what we expect them to do: slow down loan creation and inflation. This is the environment we all grew up in. Alice is in the real world. When government debt is high, and as much money creation comes from fiscal deficits as it does from bank lending, then it becomes a tug of war. Higher interest rates have mixed effects. as they do suppress private sector lending, but they also increase the deficit by a similar degree. In this case, Alice is on the precipice of the mirror, not yet through it. When government debt is extraordinarily high and far more money creation comes from fiscal deficits rather than bank lending, higher interest rates can become outright positively correlated with inflation. Alice has gone through the looking glass, and everything is flipped. Obviously, the topics of government spending, interest rates, inflation, and Fed policy, all of them important for all investors. When we see something that says all of that may have flipped and everything is now different, that should get our attention. Thus, it's important for us to understand, how is it possible that everything has flipped and everything is different? Now, the good news is the United States is most likely here, moving towards this level down here. Conceptually, how is it possible that higher interest rates can become outright positively correlated with inflation? Because the private sector's primary concern is deficit spending. And when you already have an enormous amount of debt and you raise interest rates, then the federal government's interest expense on that debt goes up significantly. And when that happens, deficits rise significantly, thus exacerbating the problem that's making investors be very, very careful with bonds and skeptical, and rightly skeptical, that the government's going to get its fiscal house in order. In terms of the way markets operate in the real world, there's almost an infinite number of factors impacting market outcomes. Interest rates, very important. Deficits, important. And as we'll most likely cover in more detail in a future video, demographics, also very important. Very important in this window, very important in this window. And in the present day, if we're trying to navigate between a point A and a point B that could be several years down the road, it's good to have a basic understanding of how the millennials might impact economic and market outcomes and how the baby boomers might impact economic and market outcomes. Typically in U.S. history, retirees are a drag on the economy. Hypothetically, if you worked for a major corporation in the U.S., years ago you retired and you received a pension from that company, which was a drag on earnings. The baby boomers are part of the 401k generation, and the baby boomers had $74.8 trillion in net worth at the end of the first quarter of 2023, and they've just started to spend it. Yardeni Research. Thus, in the present day, we have millennials currently in their peak earning and spending years, a significant driver of secular bull trends. And we have retired baby boomers that like to spend money on travel, leisure, entertainment. They like to eat out, and they also have a tendency to help their family. That's a lot of money potentially spilling into the economy from IRAs. So when we think boomers, especially wealthy boomers, they have money to spend on discretionary items. Discretionary purchases, discretionary services, travel. Chart is consumer discretionary, advanced decline volume percent. Typically, when you move from low levels down here to the green line, it's a good sign for the stock market and the economy. Had a double spike here, a double positive spike, 2 spikes in 2023. So this, which is similar to this and this, also tells us we should be open to the possibility of better than expected stock market outcomes looking out several years. We're not talking about the next 3 hours, the next 3 weeks, or even the next 3 months. These are long-term probabilities. There's a lot of volatility between this point A and this point B. And there's a lot of volatility from this point A to this point B. You know, in the markets, it's very, very easy to always be short-sighted. I think most of us would be pretty satisfied with a gain approaching this figure or a gain approaching this figure looking out several years. A lot of ups and downs between point A and point B. Talking about long-term trends, and all trends have 100% normal and to be expected counter trends. The demographics matter, millennials and boomers. Covered this chart recently It also aligns with that theory. Covered this chart recently, also aligns with that potentially bullish theory. This really doesn't look anything like this bearish turn in 2007 and 2008. Our buddy Wayne, engineering background, recently ran a detailed price pattern recognition routine, which compared 12 different measures of performance over the first 6 months of 2023 to stock market history. The best match was 1958. We just said the present day was similar to this window right in here. This is 1958 right here. Aligns with the secular trend thesis. What other years matched up well? 1955 occurs within the context of a secular trend. 1999 at the end of a secular trend. 1985 in the middle of a secular trend. 1989, we just said, secular trend thesis tells us that the present day is similar to early 1989. Price action in the first half of the year, similar to 1989. 1995 occurs within the context of a secular trend. 1997 within the context of a secular trend. 1954 within the context of a secular trend. 2021, secular trend. 1988, secular trend. This is in 1988 right here. Go back and watch this video. You can find it by Googling the title on your screen, and then come back and put these dates on the charts covered in that video. All of this, every single case, top 10, all within the context of a secular trend. Also seems to align with the secular trend thesis. Yardeni Research, analysts have stopped lowering their consensus expectations for S&P 500 forward profit margins. As a result, earnings forecasts, they've been rising, not falling. Doesn't seem to align with the imminent recession theory. Nor does any of this data on your screen. Neither. In recent decades, the two economic measures we have put the most weight on are real personal income, less transfers, and non-farm payroll employment. We have an NFP report coming out Friday. This portion of the video is being recorded on Thursday evening. We don't have any significant deterioration in real personal income excluding current transfer receipts. You can compare the present day to past recessions. If we zoom in on this area here, dataset just made a new all-time high. That doesn't mean it's not about to turn down. It may turn down very, very soon, but it hasn't turned down yet. Everything that we just said about the previous dataset, for the most part, aligns with total non-farm payrolls as of Thursday evening. So to get a situation like this, or this, or this, or this, we really need to see several non-farm payroll employments that show job losses, negative numbers. And again, that may happen very, very soon. It may happen tomorrow, but it hasn't happened yet. Given what we know today, a bias for higher inflation and higher rates, topics that aren't necessarily a showstopper for a bull market, our primary task is to try to successfully navigate between a point A and a point B that could be several years down the road, understanding that there could be a lot of 100% normal and to be expected volatility between the point A and the point B. Earnings expectations align with the weight of the evidence. We also want to be constantly monitoring the secular trend thesis. Does it still look like a secular trend? We've covered the concepts behind anchored volume weighted average price lines numerous times in these videos. In short, above the green lines, constructive and not particularly concerning. Concerns would increase if we move into this area here. The longer we stay there, the more concerning it would become. So any give back that brings us back into this area here wouldn't necessarily be out of character relative to the rally off the October low. Similar situation relative to the chart of VT, total world stocks, that we've covered in videos and in recent posts. Any give back that stays in this range here, for the most part, would be classified as volatility to ignore. Not making any assumptions about what happens next. Commentary is based on the charts and facts in front of us. Similar situation with the S&P 500. October low, hypothetically, you could come all the way back in the area of 4,000. It's about a 10% drop, and it's still wouldn't be particularly alarming relative to the health of the rally attempt off the October low. Good to keep in mind we still have a gap here, we've mentioned numerous times, somewhere in the neighborhood of 4,200. Backtracking into this area here wouldn't really do any damage or change the constructive message on this chart. Similar situation for SPY. Could fall a long way and still maintain a constructive look. Price is well above the anchored volume-weighted average price line tied to the January 2022 high, something that was very difficult for the market to do during the bear market. This looks different from all of this. Recent momentum signal from the NASDAQ Composite Index. Monthly chart dated month end, June 30th, just a few calendar days ago. PPO, momentum very similar to MACD, gets a bullish cross, black above red, after having a bearish cross in place for a long time. This is Q4 of 2021. So we wanted to know, how did the stock market perform after similar crosses when a bearish cross was in place for at least 200 calendar days? We reviewed all of NASDAQ history, going back to approximately 1978, and market returns walking forward after similar crosses. Extremely satisfying. 1, 3, 5, 7 years down the road, median returns 18%, 43%, 73% and change. 7 years out, a big, big number. This is for the S&P 500. Cross was on the NASDAQ Composite. How did the NASDAQ perform walking forward from these same dates? Better, worse, or about the same? Answer: better. Similar numbers, medians, 26 and change, 53, 96. Very satisfying. This just happened. It's something that we can see and measure. It's observable evidence. Does it align with or contradict everything covered in this recent video, which you can find by Googling the title on your screen? Anything else? NASDAQ Weekly RSI. Looking at data going back to 1978 for the most part, all of the data. Pretty rare when RSI gets down here and then makes it back to here. Only a handful of cases. If you know your market history, these are pretty constructive years shown on your screen. Something similar just happened in 2023. Everything constructive that we covered on this chart dated June 9th also applies. Compare the present day to 2009 and 2003, and also compare it to 2002 and 2008. Dow Jones Mid-Cap Growth Index, rate of change, when it crosses the zero line here, in all of these cases, the low was in the rear view mirror. Dow Jones Mid-Cap Growth Index weekly, very similar to the signal that we saw on the NASDAQ earlier this year. Relatively early in a new trend when CCI hits 200, instead of being overbought and concerning, early in a trend when CCI hits 200, it can signal a shift in momentum and the start of a new trend. S&P 500 stocks greater than their 200-day moving average. Earlier in the year, 2023, we moved from point A to point B. Looking at all the data, going back to 2002, similar moves occurred in very constructive areas from a risk-reward perspective. Stock market performance walking forward, very satisfying. Very similar situation here. S&P 500 record high percent index. We're looking at the 21-day moving average of a very volatile indicator. It's rare to go from this type of oversold reading to the green line up here. Going back to 2002, previous times, good things happened after something similar. Same can be said for this move in 2023 for the small cap 600. Similar moves followed by satisfying returns looking out 1, 2, and 3 years. The data that we have in front of us says we may be looking at a very long-term and attractive opportunity in the stock market, but under significantly different circumstances relative to what we're all accustomed to. Interest rates, extremely important, but not necessarily a showstopper relative to a secular trend. And it's possible the Fed is nearing a point where additional rate hikes could do more harm than good. meaning it's also possible that they're going to reach a level where they shift to the higher to for longer and they keep rates steady at a high level. If there is opportunity in the stock market, winning asset allocations could be significantly different in the years ahead relative to the rearview mirror, and hence the title of the video. Everything on your screen here is based on data that we have in hand recently in 2023. So when we see numbers like this, numbers like this, numbers like this, again based on something that just happened in 2023, and numbers like this, and 10 for 10 over here. The present day is similar to these 10 periods. Every single one of them occurred within the context of a secular bull market. And all of that makes it very easy to understand why this term still applies as long as we're thinking on this time frame. A lot of information available on our website, and the window is still open. The Federal Reserve has limited control relative to this topic, and at some point they may hit a point of diminishing returns where the rate hikes become harmful rather than helpful relative to their battle against inflation. And as a result, where does the volatility come from? We may be in a situation where the Fed, in subsequent years, pivots from hawkish to dovish to hawkish to dovish to hawkish. And most likely they're going to let inflation run hotter than what we're accustomed to, and during these periods they will try to tame it. That's where the increased volatility comes from. And history says that's not necessarily a showstopper, but increased volatility says if we're trying to navigate between a point A and a point B that could be several years down the road, we better have realistic expectations about drawdowns and givebacks and portfolio volatility. Said another way, navigating from point A to point B could be extremely difficult, but it could also be extremely rewarding. We've mentioned this over and over and over again. The Fed and inflation, they're still wild cards, and they could be showstoppers. We have to respect that. That's part of maximum flexibility. We don't want to get stuck on any story. And the only way that we can do that effectively is we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.